A very good evening to all our participants. We thank you for joining us on this special webinar presented by TaxSutra and Nextime on recent amendments in tax affecting pharma and FMCG companies. Over the course of this webinar, Mr. Maulik Doshi shall discuss the history of the relevant provisions, the rationale of the proposed amendments, and what impact the proposed changes and the Supreme Court ruling will have on the affected companies. With over 19 years of experience in cross-border tax, Maulik is the Deputy Managing Director, Transfer Pricing and International Tax at Nextime, whereby he also oversees the Transaction Advisory Services function. A chartered accountant by qualification, he advises multinational corporations on Indian and foreign transfer pricing rules in all contexts, including planning, litigation, advanced pricing agreements, and documentation studies. He has been recognized as a highly ranked practitioner by Euromoney's transfer pricing expert guides. With extensive capabilities in international tax planning, he also assists multinational clients with inward investment advice, cross-border investment structuring, contract structuring, permanent establishment issues, and expatriate tax matters. Before I hand it over to Maulik, I would like to take the opportunity to apprise you all that in the last 15 minutes of the webinar, we will host a dedicated question and answer session. With this, you may post your queries in the Zoom chat box. With this, I now hand it over to Maulik.
Thank you, Tanaya, and a warm welcome to everyone. Good evening. As the weather outside is hotting up, so is the tax phenomenon as we kind of come to the year end and start the next financial year. The Finance Act or the budget was presented by the Finance Minister earlier in February. And we saw just last week that the Lok Sabha has passed the finance bill with certain amendments. And it's being now widely debated in Rajya Sabha yesterday and today. Some of the changes that are kind of being recommended or being proposed by the finance bill is what we are going to discuss in the today's webinar. And the focus is on two main provisions of the law, which is a larger and a very wide impact and implications on healthcare, pharmaceuticals, FMCG companies. The two provisions that we are kind of broadly going to cover is the amendment that is proposed by the finance bill in section 37(1), which is disallowance of a particular expenditure, and the entire new tax deduction section that is now brought in, section 194R. And how does 194R apply? What are the issues under 194? What could be the practical challenges that could come across? And how does the company mitigate this entire thing? So these are the two broad aspects that we are going to discuss. In some sense, the disallowance under 37(1) and the amendment in 194 has some bit of an overlap, has some bit of a kind of a integration. It's an integrated issue in that sense. So we are going to kind of discuss how that affects businesses. So let me kind of straightway jump into the topic and discuss about the first part, which is on the section 37 itself. Now, the amendment in section 37 has a timeline and a history to it. This amendment was brought in June 1998. It was added as an explanation 1 to section 37, but it was added as a retrospective effect from 1st April 1962, which was another amendment not talked about so much as the 2012 one, but this was also with retrospective effect from 1962. The explanation 1 that got added from in 1998 was basically that any expenses incurred by the companies on account or by the taxpayers, which is for illegal activities, would not be allowed as a deduction. And there is a very interesting kind of history to this entire thing, because there were case laws and there were kind of judicial precedents which had in some sense allowed, say, for example, payment of protection money or payment of extortion money in order to protect the employees. Maybe he's posted in an area where there are threats from Naxalites, etc. So from that perspective, this kind of payments were made and they were claimed as a deduction. And there was a judicial history that kind of allowed such kind of a deduction. To some extent, while the law got introduced says that any expenses which are in the nature which violates any law would not be allowed from the tax deductibility perspective. Now, in the context of pharma and health company, this is slightly much more kind of relevant, while it would kind of have a wider application, but more important from a pharma healthcare company, because even CBDT did come out with a circular in August of 2012 talking about the admissibility or inadmissibility of expenses for pharma companies. So, but before that, in December 2009, the Indian Medical Council kind of notified regulations, and Regulation 6.8 spoke about what are the activities that are kind of allowed or what are not allowed. And it did provide that as a medical practitioner, you are not supposed to receive certain gratuitous benefit that generally which the pharma companies will try or someone will try to push that. It is in a violation of your conduct. This regulation got amended in 2016, which prescribed for certain kind of action or penalties against the medical practitioners. But in essence, the issue was that if an expenditure is incurred by a pharma company, where the recipient is prohibited from taking a benefit of that expenditure, would it get attracted under 37(1). So we had that kind of judicial precedents or had those kind of case laws building up, and I'll cover them in the subsequent slides, so I'm not going into detail right now. But then the Finance Act or Finance Bill as of now of 2022 did make an amendment, and we'll discuss the amendment, what is the change that they have brought in. And there is also a Supreme Court ruling that came in February 2022, which is very similar to what the change is being brought out by the Finance Bill. So again, the Finance Act of 1998 that introduced this provision with retrospective effect provided that no deduction or allowance will be granted for an expenditure which is an offense or which is prohibited by law. So basically, the intent of this explanation was to disregard all deductions for illegal activities, payment of protection money, extortion, nafta, bribes, which were claimed by business houses as deductible expenditure, which were also allowed by judiciary in many cases. The idea was to kind of overcome the effect of these judicial decisions and provide that this expenditure would not be allowed at all. So if you remember, there's a Bombay Tribunal decision in case of Pranav Constructions, extortion money was allowed as a revenue item. Thereafter, this CBDT circular I mentioned about, kind of it provided that unlawful expenditure is not really an allowable deduction from a computation of income. From a pharma company perspective, CBDT in that 2012 circular had provided that providing for gifts, hospitality, conference or travel, which is given by pharma companies to medical practitioners as freebies, is not allowed as per the IMC regulation, and therefore they are not to be tax deductible. And you anyway had the provision of section 28(4), which we are going to discuss subsequently also, which said that any sum which is equivalent to the value of these freebies enjoyed by these medical practitioners or association of doctors would be taxed as business income or income from other sources, as the case may be. Now, what are these IMC regulations? Because the law till now kind of revolved around this only. So basically, the IMC regulations actually is applicable to the medical practitioners and not so much to the pharma companies. It prohibits the medical practitioners from receiving any gifts from any pharmaceutical or allied healthcare company or their sales representatives. It prohibits the medical practitioners to avail any travel facilities inside or outside India for self or for family, for vacation or for attending any conference or seminar as a delegate, again from any pharma or allied healthcare company. The IMC regulation also prohibits not to accept any hospitality either individually for self or with any family members under any pretext. They should also not accept any monetary, cash and monetary benefits under any pretext. They should not kind of endorse any drug or a product of the industry publicly. So these are the unethical acts which were defined by the IMC regulations. And the whole issue was that when the pharma company used to provide this, the argument of the pharma company is that IMC regulations are applies only to medical practitioners. Pharma companies are not under violation. If at all the medical practitioner who is receiving such a thing is under a violation of a particular law or a guidelines, but pharma company is not. The CBDT circular which came out in 2012 is only prospective. It can't apply to the earlier years. In fact, the CBDT circular exceeded the scope by providing that by extending the IMC regulations to pharma companies also. And therefore, the expenditure incurred by pharma companies were neither an offense nor prohibited by law, and that should be allowed. This is the crux of the battle till 2022. And there are several decisions in favor of the pharma companies, including PHL Pharma, Zeno Pharmaceuticals, Glenmark Pharmaceuticals, etc., which had allowed this. Obviously, there were certain decisions which were kind of very, very different from a fact perspective, where either expenses incurred on referral fee or commission for prescription of medical or lab reports that were clearly not allowed. You had a decision of CapScan or Liva Healthcare, which clearly disallowed the payment because they were directly in linkage with a violation of a law. And then Bombay Tribunal in case of McLeod Pharmaceutical had referred this matter before the special bench. So the key question was that since IMC regulations are not binding on pharma companies, can the expenses incurred by them be considered a violation of any law? Now, the Supreme Court ruling came in February of 2022, which is very critical because irrespective of the amendment that is being brought in by the finance bill, I think the Supreme Court ruling is very, very clear and critical in terms of laying down the policy on this matter and laying down the law on this matter. What some of the key aspects that are discussed in the Supreme Court ruling are that if there's a prohibition on the medical practitioners from accepting any gifts or freebies, it was no less a prohibition on the part of the giver or the donor also. So it equally applies to the giver or donor not to provide these freebies or not to provide these gifts. Another principle that was laid down or another aspect that was discussed was that no one should actually be allowed to profit from any wrongdoing. And the fact that statutory regimes should be, all statutory regimes, all law should be coherent and not self-defeating. Doctors and pharmacists are complementary and supplementary to each other. The various tribunals that had allowed this law had really done a very narrow interpretation of explanation 1 to section 37(1), which actually defeats the purpose for which it was inserted. And they said that why the CBDT circular is clarificatory in nature, it is regarded as applicable from the date when the IMC regulations were not notified. And also, into that extent, it is provided for retrospective nature. So the CBDT circular came in 2012, the IMC regulations in 2009. So to that extent, the CBDT circular would apply from 2009 onwards. So this is the key takeaway from the Apex ruling. There are a lot of discussions in this ruling, which there were discussions on moral principles of public interest, rather than purely going by the legal issue. But as of now, this is the law of the land. And the Supreme Court has concluded that as long as there is a prohibition on medical practitioners from accepting this thing, the prohibition equally applies to the donor or the provider of gifts. And to that extent, if any companies have done that, it's a violation of law, and therefore, based on explanation 1 to section 37, the amount would not be allowed as a deduction. So that is the Supreme Court ruling which kind of provided for this thing. Then the amendment in section 37(1), which is more on lies in with the Supreme Court ruling, at least the one aspect is in line with the Supreme Court ruling. Obviously, 37(1) amendment that is being proposed by the Finance Bill is much larger, encompassing. But at least on the aspect of this, where the recipient and the giver, on that aspect, it is in line with the Supreme Court ruling. And the amendment was proposed earlier on 1st of February 2022, and the Supreme Court ruling came after. So in that sense, it is a vindication of the amendment that was being brought in by the Finance Bill. So explanation 3 is now added, which actually explains, or which kind of elaborates the meaning of what is an offense, or which is offense, or what is prohibited by law. And it is now saying that an offense or something which is prohibited by law shall include, and always deemed to have included, the following aspects. If an expenditure is incurred for any purpose which is an offense or which is prohibited by law in India or outside India, the outside India wordings are now added. If the expenditure is incurred which provides a benefit or perquisite to a person, whether carrying on business or profession or not, and acceptance of such benefit or perquisite is a violation of any rule, regulation, or guideline which is governing the conduct of that person, of the recipient, then also it is an expenditure for the purpose of an offense or an expenditure prohibited by the law. So this is exactly this portion. The second limb is actually what the Supreme Court has said. And any expenditure incurred for any offense under any law for the time being in force, either in India or outside India. So compounding fees, settlement fees, those kind of things now gets covered. So this is what the explanation 3, which is, according to me, extending the larger ambit of what gets disallowed under section 37(1). Now, we understood the second limb, the history behind the second limb, and the Supreme Court ruling also. For the compounding part, we had seen that there were so many cases where the taxpayers were kind of taking a deduction of the compounding fees paid to either SEBI or RBI or for exchange control violations, etc. And they were regarding this as a tax deductible expenditure because it was not really in the nature of fine or penalty. And therefore, they were saying that this is fees, compounding fees or settlement fees, and therefore should be allowed. This was the argument. Now, this is specifically provided that compounding fees for any offense under any law, either in India or outside India, would not be allowed. And this outside India also kind of assumes importance because we have seen so many cases that so many times that the larger Indian multinational which have operations outside India, if there's a violation of any immigration rule or if there's a violation of any patent obligation outside India, they tend to do an out-of-court settlement because the legal process is kind of quite protected. And they kind of, rather than spending time and money and efforts on the legal battle, they might as well do an out-of-court settlement. So there are either an arbitration through an arbitrator or through an out-of-court settlement, they agree on certain amounts to be paid. Now, this also question is whether that would fall under the fact that it is a compounding of an offense, because ultimately you are agreeing somewhere to the offense, or you are kind of trying to come out or settle the offense and kind of by piece, whether that would be allowed as a tax deduction or not. Now would be under question. With the amendment, my personal view is that such kind of an expenditure would be very difficult to allow as an expenditure. So this is the intent of bringing section explanation 3 to section 37(1). This is a new proposed amendment that is there. So now let's look at some of the examples or some of the cases which either intention-wise or not unintended unintentionally will get covered and what could be the ramifications of it. So the first case is that what happens if a company invites a foreign doctor to deliver a seminar on a therapeutic area and kind of makes a payment to the foreign doctor for this thing, whether this would be disallowed under 37(1) or not. So here it's interesting to know that the IMC regulations are applicable only to Indian medical practitioners, not really to foreign doctors. And to that extent, the recipient, a foreign doctor who is receiving any amount for either payment for stay, conference fees, any gratuitous amount, etc., is not really violating any law in India, because IMC regulations don't apply to that. And assuming that the foreign country where the doctor is kind of based, that does not have any such kind of a guidelines like the IMC guidelines in India. In which case, whether this payment would be allowed, that's a question mark. Very legally speaking, technically it should be allowed because it is not in violation of any rule or regulation, because the IMC regulations don't apply to a foreign doctor. Then there are cases where there are gray areas where kind of whether it is a violation of IMC guidelines or not itself is a very difficult thing to kind of decide, because we have seen the entire thing would now rest on deciding and interpreting the IMC guidelines and saying that whether this is a violation of IMC guideline or not a violation of IMC guidelines. So if a company invites a medical practitioner as a speaker in his annual conference on a medical topic for the benefits of his in-house doctors or scientists, etc., whether this is really in a violation of a IMC guideline or not. So one has to kind of look at that. Coming more closer to our fraternity, to chartered accountant fraternity, for example, if a chartered accountant charges fees which are based on a percentage of profits or on success of a particular assignment or a success fee, right? Quite very well known in success fee. The question is that the institute regulations, the Institute of Chartered Accountants of India, prohibit chartered accountants from charging anything which is as a percentage of profit or which is as a success fee based on a success of an assignment or a success of an event. Now, whether the company, while the chartered accountant obviously would be in violation and there will be ethical kind of conduct on that, whether the company which is making the payment, whether for that person also, for the company also, whether that amount would be allowed as a tax deduction or not is a question, because based on the reading of the law, since this were kind of prohibited by ICAI, it is in violation of a law. And to that extent, even the peer company would have to take care of all the payments that it is making and seeing that the payments for the recipient also is not really a violation of a law. We spoke about compounding fee as per the direction of RBI for some technical violation, for say, for example, delay in filing the FCGPR forms or the share allotment forms, right? Whether in those cases, whether the compounding fees that are being paid as per the direction of RBI, whether they are a violation or it's a technical violation. And you can kind of take this ahead, like, for example, the late charges that we pay to the MCA for filing financials or board meetings or directors' intimation on a delayed basis, or kind of late charges paid under various other laws, or amnesty schemes that are there, not really the Vivad Se Vishwas, the income tax amnesty, but on the indirect tax side, under the GST or the VAT, central sales tax, entry tax, profession tax. There are so many amnesty schemes that come and they need to pay a certain amount. So whether all those would be really called as a violation of a law and therefore not allowed, or they are merely kind of some technical delays and therefore they are late charges or late payment fees and therefore they should be allowed. So this is an area that will become more interesting, and this is an area where there will be kind of a lot of litigation unless kind of government really comes out with a very detailed FAQs and detailed list of what is allowable, what is not allowable. But at least there are 2 or 3 immediate action points for the companies to consider and kind of look at such kind of a scenarios and see whether the tax deduction claim that they are making is the rightful claim or not, or what could be the chances of the claim getting disallowed and interest penalties, etc., exposure coming onto the company. We discussed some of this. So payment of consent or settlement charges to SEBI under SEBI guidelines for avoiding long-drawn litigation, late submission or late filing fees under Pharma or company law. We kind of discussed that also. And settlement fees paid outside India to courts or settlement fees directly paid to third parties. Sometimes certain fees are payable to courts. Sometimes certain fees are payable to the party who has kind of drawn up the litigation. So in either case, whether that will get all covered under 37(1) explanation 3 and therefore would disallowed is a question mark, and companies are to take each and every case, examine it, and then make a claim for deduction or not. So in essence, there are immediate action steps for the company. They have to start reviewing their agreements and the payments that they are making, ensure that the payments they are making are aligned with the regulatory guidelines. And here I think a major task comes, not only regulatory guidelines that are applicable to them as a company, but even the regulatory guidelines that would be applicable to the recipient. And you need to ensure that the payment that you are making, the amount that he is receiving, is also not in violation of any guidelines that as a recipient becomes applicable. So it's a very, very onerous task and a big change in terms of looking at what kind of payments would get covered over here or not. Obviously, the few that I mentioned about fine penalties, fees, all of those would have to look at it, would have to really look at that particular law and see whether it is a violation of the law and therefore I'm making this payment, or is it only possibly not a violation but only a late payment which is kind of allowed under the law, and therefore there is no other kind of a prohibition that is imposed by the law. For pharma companies, obviously they have to identify a lot of their sales, marketing spends and see whether it is. And like I mentioned, to a certain extent, this is linked with 194R and that we are going to cover, but we'll have to review the existing structures in light of this amendment as well as the 194R amendment and see how this kind of is going to impact the entire thing. So let's kind of understand this 194R, the new TDS section that is coming on. The TDS on benefit of Perquisite that's being introduced by this finance bill. So quite interestingly, we have seen the last few finance bills or finance acts budget being kind of introducing one or the other sections on the TDS side. So the ambit of TDS is kind of pretty much increasing, and kind of we discuss this at many forums. We discuss this kind of mostly in the lighter vein that in some sense we are acting as an employee of the government or an agent of the government in collecting these taxes and paying it to the government. And this free service that I'm doing for the government is kind of the obligation under that service is increasing and is becoming very onerous on a day-to-day basis, right? Because pretty much everything that you pay or do, you need to ensure that the right tax is deducted. And something which is also where you're not paying, actually not making a payment, but some kind of a benefit or perquisite is given, the right tax is deducted. But for 194R, I think there's a good amount of history, and kind of the government has made in the post-budget a lot of interviews given by revenue secretaries, by the finance minister, etc. have kind of clearly spelled out why there was a need for this section. Essentially, the benefits or perquisite that people used to receive in the conduct of business or profession was always taxable in the hands of the recipient. And we'll kind of look at those provisions in a while. But it was very difficult to track and catch those kind of receipts in the hands of the recipient. Neither the recipients were voluntarily offering that to the tax. And in some of the cases, I think the one particular thing that got widely reported in the newspaper was that in a particular company's case where they had conducted search operations, they realized that almost 130 crores of benefit or perquisite was paid, and none of the recipients had offered that to the tax. And to that extent, it's a leakage of revenue. Right? So from that perspective, the idea of bringing this section 194R to ensure that the payer actually does the TDS, they deduct the taxes, it gets into a system, starts getting tracked, it gets reflected in 26A, so the recipient also does not have an option but to offer that to tax. So the idea is to bring it kind of and account it and kind of ensure that the recipient pays the right amount of tax on that. So what is this 194R that is being brought in? So a new withholding tax provisions or new TDS provision, which provides that a withholding tax of 10% would apply by the person who is providing the benefit or a perquisite to a resident who carries on business or profession. So when a recipient receives any benefit or perquisite in the conduct of his business or profession, the payer of that benefit or perquisite will have to deduct taxes at the rate of 10%. This would be applicable from 1st of July 2022. The threshold is rupees 20,000, a very, very meager threshold per year. Obviously, it does not apply to individuals and HAFs who are not liable to tax audit, like any other TDS provisions that don't apply to them. And when the benefit is in kind, where I'm actually not making a payment, I'm giving a benefit which is in kind. As a payer, I need to ensure that the TDS that was required to be deducted, the tax which was required to be deducted, is paid by the recipient before I provide for such a benefit. In the recently passed amendments in the Lok Sabha, while moving the bill in the Lok Sabha for the passage, there is an additional provision that is being introduced that now provides power to the central government to issue guidelines for the purpose of power to CBDT to issue guidelines for the purpose of removing difficulties in implementing provisions. And that particular part has now been incorporated in the section which was passed by the Lok Sabha. So I was talking about this particular income is was always taxed. This benefit or perquisite was always taxed in the hands of the recipient. So the genesis of that goes back to 1964. The Finance Act of 1964 had a provision 28 subsection 4, which provided value of any benefit or perquisite, whether convertible into money or not, shall be chargeable to tax in the hands of the taxpayer if it is arising from business and profession. It was made applicable from AY 64-65 onwards. And the CBDT Circular 20D, which is a circular which explained the Finance Act of 1964, that provided, the circular actually made a reference that the value of any benefit or amenity in cash or kind, which is arising to an assessee from his business or exercise of his profession, shall be chargeable to tax. So the difference between the Finance Act and CBDT Circular, in my view, is the addition of the word in cash. The CBDT Circular clearly mentions benefit or amenity in cash or kind. The Finance Act mentioned about benefit or perquisite, whether convertible into money or not. So it did not mention in cash or kind, but the CBDT Circular that explained the finance bill mentioned about the cash part of it also. Now, very important, this convertible into money or not, because this is the whole basis. And why I'm kind of laboring on this point is that section 194R also talks about value of providing of any benefit or perquisite, whether convertible into money or not. The wordings used are very similar to 28 subsection 4 without actually referring to 28.4. But the wordings used are very similar to the 28.4. And therefore, the question is that whether any cash benefit gets covered under 194R or not. So the Supreme Court in case of Mahindra and Mahindra had a chance to look at the terms whether convertible into money or not. And they kind of interpreted and they laid down a law that this benefit of perquisite, which is received, has to be in some other form other than money. So if I give a cash, that's not really a benefit of perquisite because that's hardcore money or cash that I am giving. And that is not a benefit or a perquisite. So Supreme Court in case of Mahindra and Mahindra has already held that this is only with respect to non-monetary benefits and not actual cash being given or actual benefit, actual money being transferred to the recipient. Also, the term benefit or perquisite, that is nowhere defined under the law. It's not defined under 194R, neither under 28.4 or under the provisions of the law. The Bombay Tribunal in case of Helios Foods Improvers actually attempted to kind of provide certain kind of definition to the word benefit or perquisite. And they said that the words benefit or perquisite are being used together in this section, have to be read together. And it should kind of draw inference or color from each other. Perquisite standard definition is that it's an obligation of one person being met by other person, directly or indirectly, either by providing some facilities or amenity, but obligation of one person being met by other person. So the word benefit also has to be interpreted in the same manner. And when one party kind of, as a part of the business transaction, provides certain irretrievable benefit or an advantage, that would be governed by the word perquisite of benefit, that will fall under the meaning of perquisite of benefit. And obviously there are kind of Webster Blacklaw's dictionary, which kind of provides perquisite definition as kind of more of a casual emolument or a fee or a profit attached to an office or a position, right? So perquisite, I think there is good amount of jurisprudence on this issue. Is the word benefit that kind of comes into question, and the question of whether how do you interpret the word benefit. And we are going to discuss some cases and whether we believe there is a benefit or not. Like one classic example, and since we are talking about the word benefit, I might as well take that example over here, is that, say for example, if a market price of a product is 100 rupees and you sell that to your customer at 90 rupees, is there a benefit, or is it more of a pricing decision between the buyer and the seller? It's negotiation between buyer and the seller. Is it a benefit to the buyer? So all of these questions, whether the word, how do you interpret the word benefit? And therefore, I think the Bombay Tribunal ruling becomes important because it says that the word benefit has to be read together along with perquisite and should draw color from perquisite, and not just any benefit that is flowing out of anywhere. So the important parameters from kind of for the applicability of section 194R and for the taxability under 28(4). Question is of non-monetary benefit, whether the Mahindra and Mahindra Supreme Court ruling would apply, or whether the circular 20D, which was issued in 64, that would kind of prevail, and that would prevail even with respect to 194R, and therefore even cash benefit gets kind of covered. Or should you go by the Supreme Court definition in case of Mahindra and Mahindra, which talks about only non-monetary benefits? In my view, it should be restricted to non-monetary benefits, because the Supreme Court has laid down a law and rightly interpreted. In any case, the cash benefits that were there, if you even go by the intention of the government when introducing the law, the intention was to capture things which were not getting tracked or captured by and were not being offered by the recipient. A cash benefit which is getting credited to the bank account is anyways getting kind of reflected in the bank account, and it's entering the accounting systems in that sense. And therefore, from a recipient perspective, it's easily to track for the tax authorities to question the recipient whether why that 1 lakh rupees is taxed, not taxed, whatever it is that way, right? So cash benefit, if the recipient has received, is easy to track, and therefore ideally should not get covered under the regimes of 194R. So pure money payment transactions should not get covered. But let's see if the government comes out with a detailed circular or FAQ on this aspect, and whether they clarify this aspect or not. The other aspect is that there has to be this benefit of perquisite that are to be linked to the business or profession. Now here again, there are certain case laws which have kind of discussed, and kind of very interesting interpretation coming out of two case laws of two celebrities. The Bombay Tribunal in case of Priyanka Chopra had held that she had received a Toyota car for carrying out the promotional activity for the brand, Toyota brand. So it was an exercise of the profession, and therefore the Bombay Tribunal held that it is squarely covered under 28(4) and it is taxable. Interestingly, in case of another celebrity, Shah Rukh Khan, the Bombay Tribunal had held that. Now, in this case, what had happened is Shah Rukh Khan had gone to Dubai to give more of a motivational talk or a pep talk to the employees of a particular company. And that company, based in Dubai, had gifted a villa to Shah Rukh Khan. So here the Bombay Tribunal said that Shah Rukh Khan did not conduct any professional activity for the Dubai company. It is not in exercise of his profession, and therefore this was not taxable under 28(4). Again, my personal view is that slightly a narrow interpretation of 28(4), but this is what the Bombay Tribunal held. So that the point that I'm trying to draw is that there has to be a nexus along with the business or profession. So let's discuss some of the case and whether 194R would apply or not. And with this, some of the interesting case, I'm sure some of the questions that you will also get covered here. A manufacturing company provides free samples to its distributors. Whether 194R is applicable or not. If 194R is applicable, what is the value to be adopted for 194R? Whether cost or market value? We may not have the answers to some of these questions. These are all open-ended questions where we kind of, hopefully CBDT comes out with a detailed FAQs clarifying these positions. But in my view, when a company provides free samples to its distributors, it is a benefit in the course of its business or profession, and therefore 194R should apply. Unlike the Perquisite valuation rules, they have not prescribed the valuation rules here for the purpose of 194R. Therefore, ideally, the government should ideally prescribe certain valuation mechanisms for purpose of 194R. In absence of that, according to me, it is from a payer's perspective, which is the cost that should be considered. Because as a payer, this is what I am kind of parting away with, the cost value of the samples that is there. I spoke about the company selling goods to at less than prior market value. Say, for example, a chartered accountant firm sends one of his partner to attend an international tax conference. Whether any benefit is received by the partner. Mind you, for a partner, he is exercising his business or profession. And therefore, to that extent, it would get covered under the nexus part, like in exercise of business or profession. But whether it would get covered and whether there is a benefit or an advantage to the partner, and whether therefore this expenditure incurred, whether there needs to be a TDS on that or not. We have seen so many instances in case of FMCG companies where they give benefit to the dealer distributor on achieving a particular target, but they are either supposed to pass it on to the retailers or wholesalers. What happens in this case? Is the distributor really deriving a benefit, or since the benefit is passed on to the retailer, can we interpret that the distributor is not deriving any benefit and therefore not subject to 194R? Or when the distributor passes on to a wholesaler or retailer, would the distributor have to apply 194R when it passes on the benefit? We have seen so many cases where a company would give a gift or a travel benefit, right? A cruise vacation or a vacation abroad. Now, what happens if I'm giving that vacation to a person who is a procurement head of XYZ Limited? As a person who is receiving the benefit, he is not doing any business or profession. He is only an employee. So technically speaking, this 194R would not apply because the benefit is derived by a person who is an employee of a particular organization and not really in the course of his own business or profession. Therefore, 194R should not apply. A company gives car as a gift to the distributor for achieving the sales target. Again, how do you do the value? Whether value of the car, inclusive GST, exclusive GST, how do you value the car? Those kind of things would be there. Whether turnaround discounts, cash discounts are to be treated as benefits for the section of 194R. Like I mentioned, something in cash, right? These are cash discounts or turnaround discounts, which are already accounted for. Whether they will be treated as benefit, and therefore there should be the TDS provision should apply, or whether they really are not really a benefit and therefore they anyways are getting captured and it should be normal income from business and profession, not taxed under 28(4) but under normal 28 provisions. And therefore, neither 194R should not apply. We spoke about cash benefit versus non-monetary benefit. What if the company gives 1 lakh cash to the distributor as a Diwali gift? whether 194R applies on that or not. As a recipient, whether the distributor would be liable to pay tax under 28(4) or under 56 as income from other sources. What happens is if the benefit that is given is cash and kind, in which case the proviso to section 194R provides that where there's a benefit that is provided which is partly in cash and partly in kind, and the cash portion is not enough to discharge the TDS liability, then the payer has to ensure that the required TDS is being paid by the recipient before making the gift or before providing the benefit or perquisite. So when a company gives a check of 10,000 rupees as cash and a gold coin, question is that whether 10,000 is a monetary benefit and therefore based on Supreme Court ruling, can I take it out of 194R and apply only 194R to the gold coin amount? So TDS has to be applied on which amount? So I'm sure there may be many such examples and many such practical challenges that would come as we start implementing and start kind of doing the compliances under 194R. The idea was to bring in some instances, some cases which kind of really require clarification. I think the government had mentioned that they are going to come out with detailed FAQs. I think with respect to 194 kind of Q and the other provisions that were the TDS and TCS provisions on purchase of goods, they had come out with a detailed circular and kind of which had kind of provided some bit of clarity on many aspects. So hopefully the government here also comes out with certain clarifications, and the instances that I kind of mentioned, they give those instances and clarify whether 194R is applicable or not applicable. One last point is that what is an implication of not complying with the provisions of 194R? And here there is a kind of a nice technical interpretation that is possible. So if a tax was required to be deducted and you don't deduct, the general consequences are that obviously you need to pay the taxes along with the interest. There's a disallowance of expenditure. You don't get that expenditure allowed unless you pay the taxes. And obviously there is a penalty under 271C and a prosecution under 276B for non-payment of taxes or non-deduction of taxes. Now, if you look at the provisions of section 201, which treats the assessee as an assessee in default, it says an assessee in default is one who does not deduct tax as per the provisions of section 17B. Now, provisions to section 194R, where the payment is made in kind or partly in cash and partly in kind, requires the payer to ensure that the required TDS is paid by the recipient. So where the benefit or perquisite is in kind, there is no tax deduction technically happening because there is no tax deduction as such. I am giving someone a gold coin and giving him the full gold coin. I'm not going to deduct 10% of the gold coin and give only the scratched one part of it, right? The gold coin is going to that person. As per 194R, I need to ensure that the recipient pays taxes on that, and the taxes is deposited before I present the gold coin to him. Now, what if I don't do that? Can I be regarded as an assessee in default? Since the section 201 talks about an assessee where there is a requirement to deduct TDS, in my view, this would not be regarded as an assessee in default, and therefore the penalty and the other consequences that follow would not be there. Now, if you look at this similar provisions were there under 194B, winning from kind of lotteries and horse races, etc., where Karnataka High Court, in the case of Hindustan Lever, dealing on a similar kind of proviso wordings, the wordings are exactly same as 194R, had held that the term deduction of tax is different from ensuring that the tax is paid, and both have different meanings. Now, post this Karnataka High Court ruling, section 271C and 276B of the Act were amended to provide for the proviso to section 194 were provided that any default of 194B would be covered under 271C and 276B. But the current Finance Act does not talk about any of such. 194 is not getting covered under 271C and 276B. So the way the law is right now, there is a possible view and there is an interpretation possible that there are no consequences of not complying with 194R where there is a payment in kind or the benefit of perquisite is given in kind. And if you go by the Supreme Court ruling in case of Mahindra where only non-monetary benefits and perquisite are covered under 28(4), and if you take interpretation, in any case the cash benefits are outside the purview of section 194R. There is an interesting legal tangle that I thought I'll bring it up, and I'll possibly close the presentation with this. I don't want to labor on the way forward, but I think everyone knows that every payment that they are now making, or the schemes, incentive schemes, especially for FMCG companies, they run a lot of schemes, a lot of various aspects to promote sales. They need to review that in light of the amendment under 194R. Especially if there are schemes that are related to promotion of a product, if there's a conference getting organized or a tour or a travel that is getting sponsored for promotion of product, there is requirement to have a robust documentation to prove that the recipient is not getting any benefit out of it. And obviously, one has to make changes to the systems, lay down processes in place to ensure that the compliance with 194R is done and there's a timely payment of TDS and filing of returns. So this was very broadly that I wanted to cover. We can take up the question answers right now. And if anyone have any questions, they can put it on the question answer box and we'll take it up one by one.
Thanks, Maulik. We do have a couple of questions. The first one says, 194R casts an obligation on the payer to ensure taxes are paid. It does not mention who should pay tax, that is the recipient or the payer. Is this understanding correct?
Yes, that understanding is correct. It casts an obligation to ensure that the taxes are paid. There could be a scenario where, for example, as a payer, like I mentioned an example, I'm gifting a gold coin. And therefore, I really don't want to embarrass the recipient because anyways, I'm doing a gratuitous payment. I may pay the taxes and gift a gold coin to him, right? So the TDS, I may do the TDS, gross it up and do the TDS and still give the, so it's not necessarily that it has to be by the recipient. It can be by the recipient or the payer.
Right. The next question is, how is this to be interpreted as per IMC? Would brand reminders to doctors qualify as a gift? I think it means how is gift to be interpreted?
I think also that, so that's like I mentioned, so that IMC regulations are quite broad. I'm not sure what is meant by brand reminders to doctors, but if there is any payment or any gift that is being given to the doctors to promote a particular brand, then it would definitely be covered under IMC and it's a violation of the law. And to that extent, it would get disallowed under 37(1).
Okay. Another question is, what is the scope of medical practitioners under IMC? Are certified homeopaths, nutritionists, and Ayurvedic practitioners covered, or should we look at any other specific regulations governing these practices?
So I'm sorry, I don't have that answer immediately. I've not really studied so much of the IMC regulations. I can get back on this aspect, but I'm sure similar, if the IMC regulations are not directly applicable, I'm sure there will be other regulations there under the respective code, like we have Institute of Chartered Accountants of India. I'm sure there will be something on the homeopathy or Ayurvedic that will get applicable to them. So I'll get back on this answer mode in a detailed manner. As of now, I don't have immediate or a direct answer to that.
Okay. Another question is, in case we gross up the tax, and deposit without using the PAN of the deductee at 20%, then I will face issues with filing TDS return. In case I mention the PAN of the deductee, then deductee will face challenges in his tax return. So how to resolve this? Any idea?
Deductee will not face challenges in the tax return if he offers that to the tax. The whole purpose of that is that the deductee has to offer. If he receives a gift which is taxable under 28(4) or 56, he has to offer that to tax and pay taxes on that. So yes, to that extent, he will not face any issues. But if he does not offer that to tax, that is the purpose of this bringing section 194R. And to that extent, there will be challenges.
Okay. We have time, right? Maulik, I can ask.
Yes.
Okay. It says whether sponsorship of registration fees paid of conferences for doctors will be covered by the MCI regulations.
Again, not really an expert on the MCI regulation, but to the extent that I have studied, it is getting covered under the MCI regulations. The MCI regulations are quite broad enough to cover this kind of stuff.
Okay. In case of advocate, will travel expenses come under 194R?
Very interesting. We discussed that today morning only internally. According to me, it should not get covered because it's not really a benefit for the advocate. You are asking the advocate to travel to Delhi to kind of appear before the court for your own case. So it's in discharge of his kind of obligation. And to that extent, whatever expenditure you incur, it's not really an advantage or a benefit to that advocate or a lawyer. And therefore, in my personal view, it should not get covered.
Okay. We have a couple more questions. Maulik, till when can I ask you questions?
So go ahead. I think we can complete the questions. Anyways, we have 3-5 minutes left to our closer time also. So
okay. Perfect. Are there any other regulations governing the conduct of medical practitioners in India?
Again, I am not 100% sure on this. The number of laws in India are so wide that it's very difficult to kind of see whether there is any particular law for all-encompassing law covering this or not.
Okay. What if the incentives given to doctors are routed through hospitals or some other entity? Oh my God. Okay. Will it be deductible?
Yeah, if the doctors are employees of hospitals, to that extent, this is not really, because then it goes into the employment income and therefore it would get covered by that.
Okay.
So it would not really get covered under 37(1) if they're employees and not medical practitioners by their own conduct.
In case of gifts, the IMC levies penalty if amount exceeds rupees 1,000. So does it mean that any gift less than rupees 1,000 is allowed?
That's the right interpretation.
Okay. Another question is whether cost spent on the conference charges for dealer conferences will be covered in 194R.
So that's what it becomes very important to understand what the conference is for. If the conference is to promote the company's own product, the interpretation that I would like to take is that the dealer does not really get any benefit out of it, and therefore the 28(4) or 194R does not apply. But if the conference is very generic in nature, or it's more of a sightseeing rather than a conference, then really taking that argument won't kind of help, and therefore 194R would apply in that. So the purpose of the conference, the objective trying to be achieved by the company, and what is the benefit to the dealer, that needs to be seen.
Okay. Whether the deductor is absolved from the liability of getting treated as an assessee in default if the TDS at 20% is deducted in case the deductee is not willing to share the PAN, or if the PAN is not available?
Yes, I think so. As long as the 20% deduction is happening, if the PAN is not available, I think from a deductor perspective, nothing more can be done. And therefore, I don't think so you will be regarded as an assessee in default.
Maulik, a lot of people want answers from you, so I'm going to continue.
No problem.
The conference is conducted now at Switzerland. Now, what's going to be the implications there?
So again, like I mentioned, what is the purpose of the conference? Whether it gets any benefit to the dealer or the distributor who is going. Look at a classic example. If a pharma company or a FMCG company is conducting a conference in Switzerland, the idea is to kind of showcase all the new products, showcase about the company, etc. It's a 2-day conference. You are flying the dealer out, making him stay at an exquisite location, bringing him back, incurring all the flight and travel cost and the stay cost, etc. There's a cost of 5 lakhs, 6 lakhs being spent on the dealer. The dealer is not really getting a benefit or an advantage out of it because it's all company promotion. Yes, he gets to see Switzerland, but as a recipient, I will have to pay a 30% tax on that income on that 6 lakhs rupees of the travel and stay expenses. As a dealer, would I be kind of really willing to go even for such a conferences where I have to pay 2 lakhs tax on a 6 lakhs expenses? So I think all these questions will come up, and I'm sure as long as there is a proper and robust documentation to prove that there is no benefit that is being derived by the recipient, it's a very good case to argue that 194R should not apply.
Okay. Two similar kind of questions. The first participant is asking if expenditure is subject to TDS under any other section, whether TDS under section R is applicable. And a similar sort of question, I'll take that, which another participant is asked, is if a deduction is happening in 194J, will 194R still apply? So they are related kind of questions.
So I think if the deduction is happening in any other sections, then the provisions of 194R would not apply. As long as there is a kind of TDS under 194J or any other provisions of the law.
Okay. Another question is if commission is paid to doctors by persons appointed by them, what would be the implication under section 194R?
Sorry, I'm not getting the drift of this question. Commission is paid to doctors by person appointed by them.
Yeah.
Meaning doctors are appointing persons?
Right, who are paying them commissions.
I think... So first of all, commission, if it's paid in cash, according to me, that being a monetary benefit, relying on Supreme Court ruling, section 194R should not apply.
Okay. We have another question which says, will Perquisite form part of supply under GST in the hands of the recipient?
Again, it would be on a case-to-case basis. The GST law anyways is there for kind of free samples, distribution, gifts, etc. So one has to look at that. So I'm not sure whether Perquisite how it is, but if you give a gift, anyways, there's a GST law, you purchase that product with a gift, with the input GST being paid on that. So again, I'm not 100% sure whether I understand the question correctly, but Perquisite and gifts, I'm not able to kind of reconcile that part.
Okay, got it. So those were the questions for today, Maulik. So
Great.
Thank you so much for answering each one of them so patiently. And thank you for this highly insightful and crisp session on this subject. So we really thank you for the efforts that you put in. And we look forward to hosting you again on some other topic, Maulik. Thanks. Thanks so much.
Thank you so much, Tanya. Thanks, Tax Sutra. Thank you, everyone, for a patient listening. If there are questions still kind of which are unanswered, or if I'm not understood your question properly, feel free to write to me and we can go to Tax Sutra and we can kind of try and respond and clarify those points.
Sure. So should I share our email ID, Maulik?
Please, I think that would be helpful. So if there are any still open questions, we can try and answer those.
So our email ID is trainings@taxsutra.com. You can send us an email on this ID and we will forward the questions to Maulik. Thank you so much to all the participants and thanks, Maulik, once again.
Thank you.